Welcome back to my podcast, The 5 Minute Echo. Last week, we spoke about the 29 rupee problem. Most Indian investors are unintentionally locked into one geography, one currency, and one innovation cycle. So, today's episode is simple. If I am sitting in India, how do I actually invest globally? This is my perspective on how to think about investing outside India. Global investing is not gambling on any random foreign stocks. It means owning companies outside India, owning revenue streams in dollars, and owning innovation cycles beyond your local economy. Many breakthrough companies, especially in AI, semiconductors, and biotech, are all listed in the United States. That's not an opinion, but a structural reality. There are three practical ways an Indian retail investor can invest globally. First, the Indian mutual funds that invest overseas. Second, global ETFs accessible through Indian brokers. Third, direct investing abroad under the liberalized remittance scheme, the LRS, where you can invest up to $250,000 per year per individual. Each has its own regulatory consideration, but the access exists. When you invest globally, you are not just buying companies, you are buying another currency. The rupee has historically depreciated roughly 3 to 4% annually against the dollar over long periods. So, a 20% return in USD can translate into 20 to 24% in rupee terms. Your salary is in rupees, your real estate is in rupees, your PF, PPF all is in rupees. You're already India heavy. Global investing is hence a balance, not a betrayal. The Nasdaq Composite delivered roughly 28 to 30% annual returns in USD over the past 5 years. This translates to roughly 32 to 35% CAGR in rupee terms. Meanwhile, China's CSI 300 gave 2 to 5% returns, South Korea's KOSPI gave about 5 to 8% returns, Brazil's Ibovespa 10 to 15% returns. Different countries have different cycles. Over the last 3 years, NVIDIA compounded at roughly 105 to 110% annually. Eli Lilly delivered 45% or so per year. BYD about 18 to 19%, ASML 25 to 30%. Taiwan Semiconductor gave about 55 to 60% returns, while Tesla gave up to 25% returns. These are innovation cycles which are playing across geographies. This is not an investment advice. This is an observation of how capital, technology, and opportunity moves across the world. When FII money leaves India, it doesn't disappear, but it rotates. This often moves into US equities, sometimes into US treasuries, but always into deep liquid systems. The United States remains one of the largest absorbers of global portfolio capital because of its liquidity scale and earnings visibility. When institutions move billions across borders, they are reacting to growth, policy, risk, or opportunity. Ignoring those flows is like ignoring weather patterns before you start sailing in your boat. Indian mutual funds operate under an overseas investment limit of roughly $7 billion for the entire industry. When that limit gets close to being used, fresh inflows pause. Existing investments can continue. This doesn't ban global investing. This creates guardrails. Direct investing under LRS still exists. The door isn't closed, it just has got some traffic control. Right now, Indian investors have access to roughly 30 to 35 international mutual funds and ETFs that are open for fresh investments. This is in Feb 2026. Here's what is interesting. Most of these are US focused. About 6 to 8 funds track markets like S&P 500 or Nasdaq or invest in US large caps and technology. A smaller set, roughly 2 to 4 funds, gives exposure to China and Greater Asia. Europe is mostly included through diversified global funds, not standalone Europe only products. And South America, that exposure usually comes bundled inside broader emerging market funds, not as pure regional plays. So, yes, global access exists, but the distribution tells the story. It shows where the capital flows and where innovation cycles dominate. 20 years ago, global investing required paperwork and foreign bank relationships. Today, you can open an international brokerage account online and invest from your phone. Fintech has removed the friction. We are the first generation of Indian investors with direct digital access to global markets. Access is no longer the barrier. Technology has made this possible. It is our responsibility to use it wisely. So, my final thought: India will grow, but the world will grow too. Technology created access, regulation defined structure. Now the question isn't can we, the question is will we? Because wherever innovation happens, the goal is simple: own a small piece of it. This is the 5 Minute Echo. Thank you for listening. I'll see you next time.